Welcome back to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today, we're diving into a three-way comparison of the LTL sector leaders: XPO, Old Dominion Freight Line, ODFL, and SAIA.
And this is a really fascinating deep dive because the less-than-truckload market, or LTL, it's not just about, moving freight around.
Yeah.
It's really a microcosm of the entire industrial economy.
Right. And what makes this so critical right now is that we're looking at three major players who are all, they're all staring down the barrel of the exact same pretty miserable headwind.
A very prolonged freight recession.
Yeah, we're not talking about just a little dip here. The ISM Manufacturing Index, which is really the bellwether for all this, has been stuck below 50.
Which means contraction.
Exactly. Contraction. And it's been going on for, nearly 3 years now? I think it's something like 32 of the last 35 months. That is just a relentless pressure on these companies.
It is. And that pressure is actually the perfect lens for this analysis because it's forced them into three fundamentally different strategies for how to survive and maybe even thrive through this downturn.
So you have ODFL, who's sort of playing defense, right?
Yeah, they're banking on their efficiency. Then you've got SAIA, which is playing this really high-risk, aggressive offense with a massive network build-out.
And then there's XPO, who's trying to do a total tech-driven transformation, almost like a reboot.
Exactly, a complete restructure.
Okay, so let's just cut to the chase and lay out the central thesis for you right up front. Here's the core conflict we're examining today. ODFL is the most prepared due to its 74.3% OR and 30% plus excess capacity. But the best long-term bet is XPO, whose AI-driven LTL 2.0 plan is engineered to deliver over 40% incremental margins, challenging SAIA's aggressive national build-out, which is currently facing an 87.6% OR drag.
And that's the whole story right there. But it all hinges on that one metric you mentioned, the operating ratio, or OR. We really can't go any further until we're crystal clear on what that means.
Let's define it.
It's super simple, really. It's just the percentage of your revenue that gets eaten up by your operating expenses. So if your OR is 75%, it means for every dollar that comes in, 75 cents goes right back out to cover costs,
Leaving you with 25 cents of operating profit. So for you listening, just remember this the whole time. Lower is always better.
Always.
ODFL's 74.3%, that's the gold standard, world class. But SAIA's 87.6%, that's high. But it's high for a reason. It's a choice.
It's an intentional drag on their earnings.
Yeah.
They're literally paying the utility bills for terminals that aren't full yet because they're betting they will be tomorrow.
It sets up a fantastic trade-off for an investor to analyze.
It really does. So let's start with the benchmark. To really understand what success looks like in this space, you have to start with the fortress, which is Old Dominion Freight Line.
The operational fortress, I like that.
Well, they are the established leader. They've built this. Analysts always call it a competitive moat. And it's built on an efficiency and a service level that right now is basically unmatchable.
And that all comes back to that OR number.
It does. They maintain the industry's lowest OR, clocking in at 74.3% in the third quarter of 2025.
74.3. Okay, let's just sit with that for a second. Because in this business, it's all about the relative gaps. How far ahead of everyone else are they with a number like that?
They're described as miles ahead of the competition. Their closest public competitor is usually running 500 to 800 basis points higher than that, sometimes more.
So that means ODFL is turning every dollar into operating profit, 5 to 8 cents more efficiently?
Exactly. And in an industry with this kind of volume and these tight margins, that gap adds up to billions of dollars in capital they can deploy over a cycle.
But, even the fortress isn't totally immune. You noted their OR actually went up 160 basis points from last year. So why did even the best operators see their efficiency slip?
That's just the brutal math of LTL. It's fixed costs. They suffered from cost deleveraging because their LTL tons per day. It dropped by 9.0% in the quarter.
9%. That's a huge drop in volume.
It's staggering. So think about it. You have this giant fixed machine, all these terminals, trucks, salaried people. When the volume feeding that machine shrinks by almost a tenth, all those fixed costs get spread over less revenue. They're just way heavier.
So that 160 basis point jump isn't a sign of some operational failure. It's just the recession biting.
Precisely. And the key is that even when the recession bites them, their 74.3 is still unmatchable by anyone else. And to give you some perspective, their all-time best was 69.5% back in Q2 of 2022 when freight was just booming.
So that gap between the 69.5 and today's 74.3, that's basically all the coiled up profit potential just waiting for demand to come back.
That's a perfect way to put it.
Okay, so that low-cost structure is the foundation of the moat. But the other side of it, the part that makes their revenue sticky, is the service.
Correct. Customers will pay a premium if they know their stuff will get there. And ODFL's service metrics are. They're just astonishing. They're running at 99% on-time service.
99%. And that's not something they just stumbled into.
No, not at all. It's continuous improvement. Back in 2002, they were at 94%, which was already good. They have just systematically squeezed every ounce of potential delay out of their network.
I think the number that really blew me away, though, was the cargo claims ratio. This is basically the measure of how often they damage or lose a customer's freight.
And the ratio for 2024 was an exceptional 0.1%.
0.1. So they went from 1.5% in 2002 down to 0.1. What does that 15-fold improvement actually mean for someone shipping with them?
It means predictability. It means reliability. I mean, those are the two most valuable things in any supply chain. If you ship 1,000 pallets with an average carrier, you might get, 5, maybe 10 claims.
Headaches you have to deal with.
Right. With ODFL, you expect one claim per 1,000 shipments. That massive reduction in risk is why big companies pay their premium prices without blinking. They're buying certainty.
Which explains why they've been named the #1 national LTL carrier for, 16 years in a row?
16 straight years. And if you look at those competitive value maps, they're in a quadrant all by themselves. They're seen as both the lowest cost operator and the premium service provider. No one else has pulled that off.
And a lot of that comes down to their operating model, right? Single, integrated, and non-union.
That's a huge piece of it. That union-free status gives them flexibility. It's not about paying less. It's about being able to schedule flexibly and have uniform rules across the whole network. That's key to hitting both that low OR and that high on-time service number.
Okay, so all of this, the buybacks, the building, none of it happens without what the swords call a bulletproof balance sheet.
Absolutely. The financial strength is what lets them execute this countercyclical strategy without any fear. As of Q3 2025, their total debt-to-total capital ratio is just 2.0%.
2%. That's basically zero leverage for a company this big. They're completely insulated from a long recession or, an interest rate shock.
Right. They don't have to worry about their cost of capital. They just have to worry about being excellent at operations.
And that excellence lets them deploy their cash when others are scared. You see it in their buybacks, right? They spent a massive $65.4 million buying back their own stock in the first 9 months of 2025.
Which is just management shouting from the rooftops that they think their stock is cheap, regardless of what the tonnage numbers are doing in the short term.
But the real strategic weapon here, the thing that I think sets them up for just explosive growth when things turn, is capacity.
Yes. They are deliberately running a counter-cyclical capacity expansion.
Okay, explain that for our listener. They're building new terminals while freight volumes are shrinking. Why on earth does that make sense?
It's the ultimate long-term play. In LTL, your inventory isn't stuff on a shelf. It's dock doors, it's real estate, it's truck slots. If you build during a downturn, land is cheaper, labor is cheaper, and there's no pressure to fill that new terminal on day one.
So they're just building it and letting it sit.
Well, they hold well north of 30% excess terminal capacity. Their normal target is around 20 to 25%. So they're intentionally running with a lot of empty space, and they've been doing it for a decade. They've invested $2.6 billion since 2014, adding 40 service centers.
And the timing of this could not have been more perfect because of the Yellow Corporation bankruptcy.
The Yellow collapse was an earthquake for the industry. It vaporized about 10% of all LTL capacity in North America, overnight.
Creating this huge vacuum. And ODFL is sitting there with 30% of its infrastructure just empty and waiting.
It's not just that they can take that freight. It's that they can take it immediately. They don't need a multi-year plan or a big capital budget. The doors are already there.
The machine is already built.
A machine is built. So when that freight starts moving, the incremental revenue from it just drops almost straight to the bottom line. Their historical incremental margins are between 35 and 40%. They are structurally complete. They are just waiting for the market to turn on the faucet.
Okay, so we've got ODFL, the stable fortress, just patiently waiting. Let's completely shift gears now to the company that's playing high-stakes offense, SAIA.
Yeah, if ODFL is defense, SAIA is the all-out blitz. They are the classic grow now, profit later story. They are executing a really aggressive pivot from being a strong regional carrier to a true national powerhouse.
And this is all about network expansion, right? Building out their footprint.
It's relentless. They have opened 69 new terminals since 2017, and it's working. In terms of scale, their market share has climbed to 6.8% in 2024. That's up from just 4.0% in 2017. They're now the #6 LTL carrier in the U.S.
And just like ODFL, they saw the Yellow bankruptcy as an opportunity.
Right.
But they played it differently.
They used it as an accelerator. In January 2024, they bought 17 essential freight terminals from Yellow. This wasn't just about adding capacity, it was about buying prime real estate in key markets, filling in gaps in their network. It pulled forward years of strategic planning into a single purchase.
It's like buying up Boardwalk and Park Place in one move. But that kind of front-loaded investment has to hurt in the short term. You can see it in their financials.
The short-term pain is very real. Their adjusted operating ratio, it widened out to 87.6% in Q3 2025. That's up 250 basis points year over year.
And that 87.6%.
Right.
That's the direct, explicit cost of all that underutilized capacity you mentioned earlier.
That's exactly what it is. They've built the system, they've staffed the terminals, but the freight volume in this recession just isn't there yet to make those new assets pay for themselves.
And on top of that, they're fighting some serious cost inflation, too.
They are. One of the most painful numbers in their report was a severe 22.5% increase in accident claims and insurance expense. That hits the bottom line hard.
22.5%. Wow. Is that something they can even control? What's driving an increase that big?
A lot of it is structural, and it's mostly outside of their direct control. It's a combination of old claims getting more expensive to settle, that's the social inflation we talked about, and just the general liability insurance premiums for the entire industry going through the roof.
So even as they're trying to get more efficient, these external legal and insurance costs are just eating away at their margins.
Right. They have to run just to stand still. But to their credit, they are showing some pricing power. They pushed through a 5.9% rate increase, and their contract renewals in Q3 saw a gain of over 4% revenue per bill.
So the market is tight enough post-Yellow that they can successfully pass on some of those rising costs.
It seems so. Which brings us to the whole point of this strategy. The reason investors are willing to stomach that high OR today, it's the potential for massive operating leverage.
Okay, so what is the scale of that potential payoff?
The math is really compelling. The company has quantified it. For every 100 basis points of operating revenue improvement, they get 0.91 cents per share in earnings.
That is a huge earnings multiplier.
It is. Once their network starts to fill up, all those fixed costs that are crushing their OR right now will get absorbed by a flood of new revenue. The profitability should expand non-linearly.
That sounds good in theory. Is there any proof that this model actually works, especially since they built so much of it during a downturn?
There is, actually. Their new and immature terminals, the ones open since 2022, are already running at a sub-95% OR.
In this market?
In this soft market. For a new terminal with low volumes in a recession, a sub-95 OR is a huge validation of the network model. It suggests that once those terminals mature and volumes recover, they should get to the company's profitability targets pretty quickly.
And now it looks like management is signaling a pivot. They're shifting from building to monetizing.
That's right. They're cutting their planned capital expenditures for 2025 and 2026 down to the $400 to $500 million range. That's a clear signal that they believe they have enough physical capacity for now. The focus is shifting from pouring concrete to filling the doors they already own.
And they're not just waiting for the economy. They're actively using tech to optimize the network they've built. The sources mention using AI to reduce peak handles. What is a peak handle?
Think of it as a manual touch. Every time a person has to load, unload, or sort a shipment as it moves through the network, that's a handle.
So every handle adds labor cost, adds time, and adds a risk of damage.
Exactly. It drives up that 22.5% claims cost we just talked about. So by using AI to redesign their routes and reduce those manual touches, they're making their operations structurally leaner even before the big volume surge arrives. It just increases the power of that 91 cents per share multiplier.
Okay, that leaves us with the transformer of the group, XPO. A completely different approach focused on simplification first, then a massive technology overhaul.
Right, XPO's story is all about strategic evolution. They're the fourth largest LTL carrier, but the foreign thing they did was shed all their complexity. They spun off GXO, their logistics business, and RXO, their brokerage arm.
That was to get rid of the so-called conglomerate discount, right? The market was punishing them for being too complicated.
Exactly. By becoming a pure-play North American LTL company, they focused not just investor attention, but all of their management's attention on fixing the core LTL business.
And that focus has a name, the LTL 2.0 plan. And it comes with a very aggressive OR target.
It's incredibly ambitious. They are targeting at least 600 basis points of OR improvement between 2021 and 2027. That's a public commitment to take a company that was, frankly, inefficient and put it in the same league as the industry leaders.
And unlike SAIA, whose OR is going the wrong way for now,
Yeah.
XPO is already seeing real results, even in this tough market.
That's the key. That's the proof that real structural change is happening. In Q3 2025, XPO's adjusted OR actually dropped 150 basis points year over year, down to 82.7%.
To improve your efficiency that much while your revenue is under pressure, that tells you the LTL 2.0 plan is more than just a PowerPoint slide.
It is, and you see it in their pricing discipline, too. They just posted their 11th straight quarter of sequential increases in revenue per shipment. Their yield, ex-fuel, was up 5.9%. They're proving they can raise rates.
Which you can only do if your service is getting better.
Exactly. And their service initiatives have driven an over 80% improvement in damages since late 2021. They're closing that quality gap with ODFL, which is what lets them charge more.
Another big part of their plan is insourcing their line haul miles. What does that mean, and why is it so important?
It means they're replacing expensive third-party trucking companies with their own XPO drivers and their own XPO trucks. In Q3, the miles they outsourced dropped by 770 basis points.
That's a huge shift. It must add a lot of short-term cost hiring all those drivers.
It does, but what it buys you is control and long-term cost reduction. You get better service consistency, and critically, it lets them apply their proprietary AI tools to their entire network. You can't do that with a third-party carrier.
And like the others, they've been adding physical capacity too. They bought 26 terminals from Yellow and have been building their own. But the real engine of this whole thing, the true differentiator, is the technology, the AI.
Absolutely. The LTL 2.0 plan is built on their proprietary AI, what they call XPO Smart AI. And it's not just some buzzword. They expect it to drive 3 to 4 percentage points of their entire adjusted EBITDA growth target.
3 to 4 points just from algorithms. That's a huge claim. Is there any proof it's actually working yet?
There is real concrete proof. The AI has already cut their empty miles by 12%.
12%. Empty miles are pure deadweight cost. That's a massive saving.
It is, and it's also reduced their expensive line haul diversions by over 80%. Those are those last-minute, inefficient route changes that kill your margins and your service. The AI is systematically eliminating them.
So they're building a network that's optimized for efficiency before the volume even comes back.
Right, and that leads to the big payoff, the reason they're our best long-term bet. Because of all this pre-built, AI-driven optimization, XPO is targeting over 40% incremental margins when the cycle turns.
40%. That's a huge number, getting close to ODFL's historical best, but from a much higher starting OR. Is that realistic?
It's aggressive, no doubt, but it's defensible. It all hinges on them hitting that 600 basis point OR improvement target. If the AI permanently removes costs like 12% of empty miles, then when revenue comes flooding back in, those dollars flow past a much lower fixed cost base. It's a high-conviction bet that technology can let them leapfrog years of slow, painful operational improvement and achieve margin parity with the best in the business.
Okay, so we have three very different stories. ODFL, the patient fortress, SAIA, the aggressive builder,
Right.
and XPO, the tech transformer. Let's zoom out now and look at their biggest challenges, pricing power and structural risks.
Let's start with pricing power, because that's the clearest differentiator, and this is where ODFL's service moat just shines.
Give us the numbers again.
ODFL's LTL revenue per hundredweight. It rose 4.7% year over year. And remember, that happened while their volume was cratering by 9%.
That is the textbook definition of pricing power. The customers who are staying are willing to pay more to stay. They're paying a premium for that 99% on-time service and that 0.1% claims ratio.
Now contrast that with XPO. They're making great progress, but they are still trying to close a substantial 11 percentage point yield gap with the best-in-class carriers, meaning ODFL.
So that 11% gap is both their biggest opportunity and their biggest challenge.
It is. If LTL 2.0 lets them close even a few points of that gap, the financial upside is enormous. But it takes years of perfect execution to change customer perceptions like that.
And while those two are fighting over pricing, SAA is dealing with a massive structural risk that could derail their whole strategy. The CARB mandate in California.
The California Air Resources Board mandate. This is a huge, unpredictable anchor on their plans.
Why does it hit them so hard?
Because the mandate forces a very expensive and very rapid conversion to zero-emission vehicles, or ZEVs. And the problem, as the sources note, is that there are virtually none suitable zero-emission replacements for the heavy-duty trucks they need.
So the government is mandating that they buy technology that doesn't really exist yet, at least not at the scale and reliability they need.
Exactly. It's a multi-billion-dollar forced conversion risk. It creates this massive uncertainty in their capital planning, right when they're trying to shift from building to making a profit. They don't know if the trucks they buy today will be obsolete tomorrow by government decree.
Now, XPO has its own structural risk, but it's a legal one, a legacy issue.
Right. Ongoing litigation from a former subsidiary.
Right.
And the real problem here isn't the potential size of the loss, it's the uncertainty. In their own filings, they say the potential losses are not reasonably estimable at this time.
Not reasonably estimable. Those are 4 words an investor never wants to hear. It's a black hole of legal risk hanging over their balance sheet, no matter how well LTL 2.0 is going.
And that leaves ODFL. Their primary risk is completely different. It's not operational, it's not financial, it's not regulatory. It is simply timing risk.
They've done everything right. The balance sheet is clean, the capacity is ready. Their entire payoff just depends on when the economy recovers. They're a hostage to the macro cycle.
And their management is very open about it. They've acknowledged the potential for 4 straight years of tonnage decline if the economy stays this soft. It's a risk of patience, not a risk of execution.
This has been a really fascinating breakdown. Let's bring it all together for you, the listener, and deliver that final verdict.
Okay. On the question of who is best prepared for an immediate turn, the conclusion is clear. ODFL is the best positioned. That 74.3% OR, the virtually non-existent debt, and that massive 30% plus excess capacity, they make ODFL the proven low-risk fortress ready to absorb growth the second it appears. They are the safe bet.
But the highest potential for change, for long-term upside, that lies elsewhere. We conclude that XPO offers the highest transformation potential and is the best long-term bet. This is a high-conviction bet on technology. Their LTL 2.0 plan, specifically that AI cutting empty miles by 12%, supports their incredible forecast of over 40% incremental margins. You're betting on management to achieve margin parity with the elite.
And finally, SAIA. They offer that really compelling leverage. That 0.91 cents per share for every bit of revenue improvement is so attractive. But it's anchored by 2 huge headwinds. The highest current OR at 87.6% and that really unpredictable regulatory risk from the CARB mandate. SAIA is the high-stakes gamble on a fast economic recovery and a friendly regulatory environment.
So there you have it, the classic trade-off, quality now versus transformation later, all weighed against high costs and external risk.
And that leads to our final provocative thought for you to take away from this deep dive. We know ODFL says their direct variable costs are already at record lows. They're running leaner than anyone ever has. So what is their true operating leverage potential beyond what we've seen historically? If they see double-digit volume growth, could their incremental margins, which have peaked around 40%, actually hit 45 or even 50%? That question defines the true explosive potential hidden inside that fortress.
Something to think about. Thank you for diving deep with us today.
My pleasure.
Risk defined, portfolio protected.